Welcome to 2025. Cheers to a new year. Cheers to getting that bag. I'm your host, Tashawn, known online as Sensei, and I have been day trading for the past 7 years, teaching professionally for the past 4, and I have been able to pull life-changing amounts of money from the Forex market specifically. Recently, I have made the pivot over into the futures market where I have been attempting to run it up on futures prop firms. Now, this video in particular is going to be strictly for my new beginner traders, those who want to get into trading but may not necessarily know how to, may not know where to go, what to download, things of that nature. So I'm gonna get y'all right in this video. Sit down, grab a snack, maybe some water, and enjoy the video. This one might be a little long, I'm not sure, but that'll be your test, because in order to even be a good trader, you need to have patience, discipline, and resilience. That's why I made my very first video, discipline over excuses, because these are the habits that you will need in order to become a great trader. Before we get started, I'm going to tell it to you like this, straight up. The only thing guaranteed about this game is that you're going to lose money. But wait, don't get discouraged just yet. Let me finish. The only thing guaranteed is that you're going to lose money. So you need to understand how much money you are willing to lose. All right? Because there is no 100% guarantee that every time you place a trade, you're going to win it. You're going to lose trades. That is what you need to focus on. Not focusing on trying to make as much money as possible with one go. You need to understand how much money you're going to be losing if that trade was to go against you. This is not a game of winning. This is a game of not losing. All right, I'm going to say it again because I have to say it that way for a reason. This is not a game of winning. This is a game of not losing. All right. So now the information that I'm going to be pulling from is my very own website that I'm going to have linked in the description below. So you can look at it yourself after this video is done and read the specific parts that you may need, to look back on in the future. All right. But without further ado, let's hop into the website and let's get started. So here we are on the Kingdom of Profits Forex Academy website. This is mine. I built it. Here it is. When you see that money bag, you know it's me. So let's get started, all right? So the first video that you will see upon opening the website is basically explaining what is Forex. So I'll explain that to you real quick. It is simply the buying and selling of two different currencies, all right? So now let's say you took $100 USD, US dollars, and then took a trip over to Britain. You would have to convert your dollars into either euros or Great British pounds. You are not going to get $100. You might actually get a couple dollars more. Why? Because of the currency exchange rate. All right. This is how you make your money in the Forex markets, because of that exchange rate times the amount of pips that the market will move in any given moment. We're going to get into pips later on in the website. It's just a few scrolls down. All right. So let me run it back one more time. Forex trading, how you make money from it, is the exchange rate of two currencies. So for this example, the United States dollar versus the euro, the European euro, switch those. So the European euro versus the US dollar, right? That's how it's organized in the trading market, just because the euro has a stronger currency value than the dollar. So what that means is if you convert your US dollars into euros, you would get more money in euros. But if you convert your euros into dollars, you might get less money. All right, so now this same logic applies to the markets themselves. However much the market moves, that's how you can profit, right? Because you can buy and sell. So to simplify even more, take the euro versus the US dollar. You're buying the euro or you're selling the dollar. All right, let's move on. The tools you would need to trade. First thing you would need is TradingView. That is the platform that you would see all my charting work on. All right, so With TradingView, you can trade futures straight from TradingView as long as you connect the proper broker, and you can rock out. Now, for Forex, you would need to download Trade Locker. Recently, last year, we had a whole lot of drama go on in the trading community, and the government finally had to crack down. So they said that if you were not properly licensed, you had to stop servicing United States clients, which caused basically majority of these brokers down here to no longer accept US clients for the original trading app that everybody used to use called MetaTrader 4. Now, there are still some slips through the cracks where you can trade MetaTrader in the United States, but I'm gonna gatekeep those for now. So download Trade Locker. That's the platform that we will use to trade Forex on, and that is a platform that I will be using in the future just to show y'all, you know what I'm saying? There ain't nothing that I'm going to tell y'all that I'm not going to do myself or that I haven't done myself. All right. So, and also you will need a smartphone, eventually a laptop. And with those two things, you can trade anywhere in the world as long as you have Wi-Fi. That is the beauty of becoming a trader. You basically become your own boss. Seriously, you become your own boss. You set your own schedule. You can work from anywhere. But of course, you still got to get good at it first before you can call yourself doing all of that. So now let's get into brokers, because this is the most important part, because your broker is a financial institution that facilitates currency trading for individuals and institutions. They provide traders with access to the foreign exchange market and offer trading platforms, tools, and resources to execute trades. As a beginner, it is essential to choose a reliable and regulated broker and understand the conditions behind them, including what currency pairs they service, how their spreads are, and margin requirements. Right? So now I'm gonna give some context behind that one in the next section. So the difference between regulated and unregulated brokers. A regulated broker, for one, is typically US based, so it's here in the US, they have their proper licensing, and they adhere to strict guidelines that are required to maintain certain standards to protect investors and maintain market integrity. So to simplify all of that, if they do you wrong, they out. No, they don't get second chances. They do you dirty, they're gone. The government don't play that. This regulation ensures that the broker operates with transparency and fairness, providing a safe and secure trading environment for its clients. Most of these brokers, might I add, are also FDIC insured. So if you somehow, as a grown adult, don't know what FDIC insured is and you have a bank account, that means you are protected up to, what was it, about $250,000? So you can rest assured your money is good. But now the con to regulated brokers is, while yes, you are protected, you don't get that much buying power. And I'll dive into that here in a second. But let's get into unregulated brokers. Simply put, they operate with limited or no regulatory oversight and may engage in unethical practices that could potentially harm their clients. Now, before you start to panic, the odds of foul play, like I say here at the bottom, is very low. You can still use unregulated brokers and be just fine. Most professional traders like myself use unregulated brokers because they allow higher leverage than the regulated ones. But for the average trader, this could be a good or bad thing. So as a beginner, you can still use an unregulated broker, but you need to understand that even though your earning potential is increased, so is your losing potential. All right. So now here is a list of regulated brokers. Now, I gotta update the website. It's a little bit outdated, but it still gets the job done. Sway Markets is not regulated. They lied in their initial marketing, and that's why they can't use MetaTrader now. Long story short, if they are unable to use MetaTrader, they are unregulated. So the top unregulated brokers right here are Hugo's Way, Trader's Way, KOT Forex, Henko Trade, Osprey FX, and XM Group. Now, my personal broker, and the broker that doesn't pay me to talk about them, might I add, is KOT Forex. I have been trading with KOT since I began trading. They have always pulled my money out, no questions asked, no difficulties, no delays. So KOT Forex is going to be my recommended go-to for all of y'all. Every other one that's in this unregulated section, that is all on you. So now next, let me get into margin, leverage, and spread. Much simplified, because, I had to give you the technical definition in here. But margin refers to the collateral or security deposit required by the broker to open and maintain a trading position. meaning the money in your account. How much money do you have in your trading account, in your brokerage account? It is essential to manage your margin effectively, keeping a sufficient balance in your account to cover potential losses and avoid margin calls, which is the forced liquidation of your positions. So now let me draw it out for you so you can understand. Let's say you enter the trade, but you put way too much risk on this trade, and now the trade is going against you. So let's take $1,000 for example. You're messing around and you're floating $800 in losses. So you only got $200 worth of your account left. For whatever reason, you still don't close the trade. You're holding on for dear life because in your rookie brain, the trade is going to come back and it's just going to magically turn back into a profit. But the trade keeps going against you, and now eventually you're sitting at about $950-ish in the red. You only got $50 left. What may happen at that point is your broker, you're going to exceed a certain margin percentage, which will force your broker to activate that margin call, which is an attempt to save your account from being blown. But unfortunately, by the time the margin call happens, and this goes for everywhere, every broker, it don't matter, across the board, regulated, unregulated, it doesn't matter. The moment a margin call happens, it's too late for you. Your account is gone. You might even owe the broker money afterwards. So it is essential to keep your risk in check and avoid that margin call. Next is leverage. Leverage is a borrowing facility provided by the broker that enables traders to control larger positions in the Forex markets with a smaller amount of capital. Buying power. That's what leverage is. Buying power. Regulated brokers, since they care about you and want you to succeed, and they are what we call A-booked, so they trade and manage everybody with their own capital. They have more than enough to pay you out, do whatever, right? So because they want you to have longevity in these markets, they're going to give you a smaller amount of leverage, as opposed to unregulated brokers, which we call B-booked, B as in ball, where most of them make profits off of your losses. So this is why they give you an increased leverage, so you can blow your account quicker, because you're a newbie that's still greedy. You still got the greed in you. They give you vows to flip $10 into 20,000 with one trade. That's what they want you to do. They want you to try to flip accounts, try to turn $100 into $1 million without knowing what you're doing. It's possible. It's been done before. It's on YouTube right now. Shouts to FX Alex G. These folks need to sponsor me. But it is possible to grow an account like that, but you need to be good at trading. You need to master the skill. That is true mastery of the craft. And you can also the broker that you do it on with the leverage will help or harm that. All right. So leverage is buying power. Spread is the difference between the buying and selling prices of a currency pair quoted by the broker. Tighter spreads are generally better, but it's important to choose a reliable broker that offers fair and transparent pricing. You are not taxed on any profits that you make in the markets, regardless if it's Forex, futures, stocks, crypto, commodities, metals. You are not taxed on that initial profit. So if I make $1,000 right now in the Forex markets, that whole 1,000 comes to me. But there's always going to be a but. You are charged, I'm gonna call it a broker's fee, a broker's tax. So even though you're not taxed with your initial profits, your broker will charge you, let's just say a couple dollars, not even a couple dollars. It depends on how much you put on the trade, but they will charge you a couple pips. Which can vary from a few cents to a couple dollars to enter you in the trade. So that's what spread is. It is also essential to understand that spreads can widen during news releases or volatile market conditions, which can increase trading costs. So if you try to trade news events, spread will increase. If you try to enter a trade when the market first opens, every Sunday at 5 p.m. Eastern Standard Time, spreads will be higher. So I'll tell you a quick story right now. I was in NASDAQ trades. I was in 3 of them. The total profit was $9,000, but I held it over the weekend. And when the markets opened back up on that Sunday, the spreads was so wide that it covered my entire $9,000 of profit. So even though my positions were well far away from going in the red, those spreads made it seem like it wasn't such. So it's crucial to pay attention to that spread, as well as these other two up here. Next, the first part in the process of profitability. This section is going to cover all the basics. All right, so what is a pip? A pip stands for percentage in point. It is the smallest price increment that a currency pair can move. Most pairs have 5 decimal places used to calculate the pips, except for pairs that involve the Japanese yen, which have 2. So if we open up this picture here, this is how you read pips in a currency pair. We're going to use the euro versus the US dollar, for example. So the 0.1 pip will always be fluctuating, so we don't pay attention to this one. We pay attention to the first 4. You got 1 pip, 10 pips, 100 pips, 1,000 pips. So that's how you read it. So if we go from 2345 to 2355, that was a 10 pip increase. But now say if we go from 2345 to 2145, that is a 200 pip decrease. All right, so that is how you read pips. Pips is how the markets move. It's easy to calculate them, don't worry. This is all calculator work. So now let's talk about lot sizes. Lot sizes refer to the amount of currency units that are traded in a single transaction in the Forex markets. Lot sizes can vary depending on the broker and the type of account being used, but they typically range from micro lots, which is a 0.01, up to a 0.10, which is 10 cents per pip, to mini lots, which goes from 0.1 to 1.0, which is $1 per pip, to standard lots 1.0 and beyond, which equals $10 per pip. So you can see here the power of just 15 pips. With a 1.0 lot size, with 15 pips of movement, you would get a $150 return. 3.0, 450, so on and so forth. Now with a 0.10, you will get $15. And a 0.01, you will get 15 cents. That's how that works. Excuse me, you would get $1.50. I was so wrong. You would get $1.50. I'm tripping. All right, so that is lot sizes. You have full control of the lot size. So this is why I say you need to manage your risk, and risk management is key because you control how big your lot size is, depending on how big your account is. So your account will grant you a certain amount of lots. You get it? I'm gonna say that one more time. Your account size will determine the amount of lots that you can place on it, right? So for all of my rookies, you need to only work with 0.01s, 10 cents per pip. You do not need to go anywhere beyond that just yet because you still don't know what you're doing. All right, let's move on. Risk management, my favorite, is one of the 2 most important aspects of your trading. I would even say now that it is the most important aspect of your trading. Because like I mentioned before, you are never guaranteed profit when trading these markets. You can and you will take losses. Risking too much per trade can end up with a blown account very quickly. So don't worry about making as much money as possible per trade, like I said. Instead, focus on losing a calculated amount of money if the trade was to go against you. Let's dive a little deeper into this. This is an easy way to understand it. Think of risk management as the amount of tries you give yourself to make money before blowing your account. Professional traders recommend risking no more than 1 to 2% per position. For y'all, 1%. Let me show you why. Let's start with 100% of a fresh account. You're going to divide that 100 by whatever your risk percentage is. What do you get? 50. This means that risking 2% per trade on 100% of your account, you will have 50 tries, meaning you would have to lose 50 times in a row. Simultaneously, you click the button and went over 50 before you blow your account. Now explain to me why you will blow an account. If I gave you 50 tries to just win once, you're telling me you can't do that? You better than me. You better than me. So now let's get into risk to reward ratios. It's simply the amount of risk compared to the amount of reward. In trading, it is recommended to enter trades with at least a 1-to-1 or a 1-to-2 risk to reward ratio. Preferably look for the 1-to-2 because you can work some magic with that. We're going to take $100. 10 trades, 50% win rate. 2% risk will be $2. With a 1-to-1, I'm risking $2 to make $2. So after 10 trades, I will be still at break even with my account still at $100, which isn't bad. I just didn't win, though I didn't lose either, so I can't really complain, right? But now let's go over to the 1-to-2. I'm risking $2 to make $4. Even though I won 5 trades and lost 5 trades, I still profited $10. So at the end of it all, my account finished at $110. With a 1 to 3, you'd get 130. With a 1 to 4, 140, 1 to 5, 150. So now here's a little hack for y'all. As long as you trade with a 1-to-1 risk to reward ratio, you will always have a 50-50 chance to profit on that trade. You could flip a coin, click buy or sell, and you will still come out, you still have the chance to come out a break-even trader, if not profitable. Right? So don't listen to these gurus on the internet talking about, oh, you need to look for 1 to 3s, 1 to 4s, 1 to 5s. No, they're trying to sell you a course. All right. 1 to 1s and 1 to 2s will do you just fine. Now, this isn't to say if the trade goes beyond that, not to cash out, but you need the experience in order to do that. But I'm not going to tell you to try to look for these high reward ratios when you aren't even capable of consistently catching a 1-to-1 or a 1 to 2 at most. All right, let's move on. Trading sessions. There are 3 sessions that you have to consider: Tokyo, London, and New York. Tokyo session starts at 7 p.m. Eastern time and ends at 4 a.m. Eastern time. The major currency pairs traded this should be the Japanese yen or gold, right? But now this is the weakest pair, or weakest session, volatility wise out of all 3. So will the markets move during Tokyo? Probably not. London session starts at 2 a.m. Eastern time and ends at noon. The major pairs traded during this time should be the euro and the pound. This is the second strongest out of the pairs, out of the sessions. I keep saying pairs. And finally, we have the New York session, which starts at 8 to 8:30, depending on where you are, and ends at 5 p.m. Obviously, US pairs. Now, this is the strongest session out of all of them. But think about it like this. In America, you're going to start your day in New York session, but that is actually the last session of the day. The first session is Tokyo, right? In the international time zone, right? So just keep that in mind. And finally, we got the 4 trading styles. The avatar of trading right here: scalping, day trading, swing trading, and position trading. I know this is a lot to read. I'm not going to read all of that here, but I'm just going to paraphrase everything. Scalping involves taking multiple trades within a short period of time, typically within a few seconds to a few minutes. This is the pair. When you hear people say, oh, I don't want to sit in front of a chart all day, this and third, they're probably talking about scalpers. Just because with scalping, things happen very, very fast. So if you don't know what you're doing, you can get cooked very, very quickly. I don't teach my students how to scalp. I let y'all grow into scalpers. All right, because I'm not going to be responsible for you losing your money in 5 seconds. That's not my fault. Day trading involves opening and closing positions, typically within the same day to a couple days at most, right? So this pair, this way of trading, you're probably looking at it every hour, every other hour, things of that nature. You might enter a trade, go to work, come back to it after you come home from work, and then close your trade then, things like that. But now swing trading, which is my primary go-to style, involves holding positions for several days to several weeks. I don't hold my trades for several weeks. That's crazy. But I will enter trades on Monday and hold them guys till Friday, right? Traders who use this style aim to profit from medium-ish price movements. So when it comes to swing trading and position trading are the 2 slowest trading methods. Slowest meaning by the markets, because you're going to be looking at the markets from a 4-hour interval, a daily interval, maybe even a weekly interval. So you're legit setting your trades and forgetting about them. Set and forget. Now, position trading. I don't know too many position traders, but they're out there. You're holding your trades for weeks to months. I'm not doing that. You're not doing that. If you want to do it, I'm going to call you crazy, but you can do it. All right. Oh, had one more. Your trading plan. Your trading plan is basically your job description, right? Because again, you are your own boss. You are your own business. You are your own job. You're not walking into a job and they're just going to tell you, all right, go have fun. They're going to hand you this paper. You're like, all right, we in 2025. They go, it's going to be online. Your job description going to be online. It's going to tell you what you're working, where you're working at, how much you're going to get paid, etc., etc. So you need to have a trading plan. The components of that plan needs to involve your approach to the markets. How are you going to enter? Your risk management rules, your entry and exit rules, and your schedule. All right. So like I just said, the trading strategy and the entry and exit rules go hand in hand because your strategy tells you when to enter and exit trades. The benefits of a plan. It helps with those 3 habits: consistency/patience, discipline, and risk management. You need to have a plan. You need to write it down. I'll have an example of a good trading plan somewhere. I don't know where yet. Probably throw it in the corner on the other side of me here. So now some tips. You got to be realistic. All right, you got to be realistic with your plan. Look at the one that I probably have on the other side of my face here. You need to constantly test the plan and review and update it where necessary. Trading is trial and error. You're going to make a mistake, learn from the mistake to not do the mistake again, and so on and so forth. And you're going to do this time after time after time after time until eventually you're a profitable trader. Ooh, that was a lot of reading. I was gonna do an introduction to trading view and market structure and how news events can affect the markets, but I'm gonna save that for the next video. That was a lot already to digest. I know some of y'all may have to actually go back and rewatch this video or go straight to the website to get a little bit more insight. So I'm gonna cool down real quick. I'm cool down a little bit. And the next video I'm gonna come out with is gonna be all about news events and market structure because those two go hand in hand, right? So I appreciate y'all for watching to the end of this video. We are on the road to 1,000 subscribers. At the recording of this video, we are at 31. So I appreciate all of y'all for rocking with me. We got a long road ahead of us. The ball is only starting. The ball is only starting to roll. I'm excited to see what's going to happen. I'm excited to work with all of you too on the internet. So with all of that being said, I done yapped y'all heads off. I'm out. Peace.